It's no secret that investing can be difficult, especially if you're not super experienced or don't have a formal education in finance or whatever the guys on Wall Street went to college for. But even people who have zero education in finances can easily turn themselves into millionaires if they just know where to put their money. In today's video, we're going to be talking about some of the best places to put your money so that you can become a millionaire while you sleep. Yeah, you heard that right. So make sure to subscribe and hit the bell icon for notifications so you'll never miss out on cool new content from us. Now, let's get into it. So first things first, let's talk about what a stock portfolio is. If you don't have one yet, hopefully this video will inspire you to open one ASAP. Otherwise, you could potentially lose out on millions of dollars. So, a stock portfolio is basically a collection of different stocks that you're invested in with the hopes of making a profit one day. It's important when you're starting out to put together a portfolio with a good amount of diversity that spans across different sectors and industries, so that your money can be more resilient and have a better shot at making you a profit. If you don't have the time, energy, or knowledge to be an aggressive trader like some of the big shots on Wall Street, lazy portfolios might be a better option for you. Lazy portfolios are designed to have the best shot at high performance even in the most tumultuous markets. Most of these kinds of portfolios will contain a few low-cost funds that are relatively easy to manage. What makes these portfolios so lazy is that an investor can stay invested in the same stocks for extended periods of time without having to even look at them for years. This can be because, generally, these portfolios contain around 30 to 40% bonds, which is a very suitable amount to invest for most pre-retirement investors. If this all sounds confusing so far, let's break down some of the most important concepts when creating a portfolio that will make money for you in your sleep. Let's start out with mutual funds. A mutual fund is a pooled collection of assets that invests in stocks, bonds, and other securities that might otherwise be difficult to recreate on your own, especially if you're a new investor that isn't in the know of the best places to allocate your money to. This is often referred to as a portfolio. The price of the mutual fund, also known as its net asset value, is determined by the total value of the securities in the portfolio divided by the number of the fund's outstanding shares. This price fluctuates based on the value of the securities held by the portfolio at the end of each business day. Mutual funds aren't really in the best favor with the new generation of investors because they often require an active manager, which means that stocks that are chosen within a mutual fund are chosen by another person. Mutual funds have fallen somewhat out of favor because, with another human being handling your money, this means that you would be paying way more fees on the funds. And on top of that money is now the subject of human error. So that's why a lot of younger investors think they're a mistake to purchase in this day and age. A better, more favorable way to invest your money these days is through an index fund. Now, mutual funds and index funds do have some similarities, but there are some obvious differences. An index fund is a type of mutual fund whose holdings match or track a particular market index. By buying the S&P 500 index fund, such as VFIX, for around $300, you get to own a small percentage of its entire index, which will ultimately be beneficial for you and your money in the long run. The biggest difference between an index fund and a mutual fund is that it's hands-off and you could build a diversified portfolio earning solid returns using mostly this type of investment. Index funds never try to beat the market or earn higher returns compared with market averages. Instead, these kinds of funds try to be in line with the market, buying stocks of every kind to mirror the performance of the market as a whole. Index funds are really beneficial to an investor because they can help balance out the risk in a portfolio. As the market fluctuates and becomes volatile, stocks tend to be less volatile across an index fund compared to just investing in individual stocks. Index funds are also in favor of more investors these days because they typically have low fees. Their management style is totally passive. It doesn't need a human to help manage it, totally relieving the fund from any kind of human error. Like we said, index funds are very similar to mutual funds, but they have no portfolio manager, therefore saving you a bunch of money so you have a better shot at becoming a millionaire. You don't need anybody to manage the account but you. You can throw your money into these funds, leave them alone for a few years, and potentially turn a massive profit by doing absolutely nothing. So, now that we have the definitions of what mutual funds and index funds are, let's move on to something just a little more different. An exchange-traded fund, or ETF, is sort of like a mutual or index fund in that they are a basket of investments, like stocks or bonds. Exchange-traded funds allow you to invest in lots of securities all at once, and ETFs will often have the lowest fees compared to other types of funds. ETFs are also more easily tradable compared to the index and mutual funds. Its main difference, especially compared to index funds, is that ETFs actively trade on the market, so you can buy and sell it throughout the day, while index funds can only trade once per day. Since ETFs do trade on the market, you can buy and sell them as your heart desires, which, if you're looking for flexibility, is ideal. However, it's recommended to buy and hold on to your ETFs if you're purchasing one that has the ability to track the market. The other big difference that makes an ETF unique is that with online brokerages such as E-Trade, Robinhood, and so on, you may be able to buy into ETFs using fractional shares. This means that if you have just $20, you are able to buy a portion of an ETF. This is great news considering that many index funds require a minimum. For example, the VFIX has an initial minimum of $3,000. If you're a beginner, you might not have all of that money to invest right now, so an ETF might be a much better, more affordable option for the time being. But like any financial product, ETFs aren't a one-size-fits-all solution. You should always evaluate them on your own time. You should research key information, such as if they're on any management costs or commission fees, how easily you can buy or sell them, and most importantly, the quality of the investment. But all in all, these three types of funds are an excellent option for those investors looking for a more passive way to invest their money. Now that we've gotten mutual funds, index funds, and ETFs out of the way, let's talk about a different kind of approach and ways to make you a lazy millionaire. One approach that new investors should know about is the three-fund portfolio approach. A three-fund portfolio is just as it sounds. It's an investment portfolio that's built around three key funds. In an average three-fund portfolio, you'll typically find domestic stock index funds, international stock index funds, and bond index funds. As with any investing strategy, there are disadvantages and advantages to using a three-fund portfolio approach. Looking at both sides can help you decide whether it makes sense for you. One of the main pros of having a three-fund portfolio is having simplified diversification. Diversifying your portfolio is extremely important when investing and managing risk. Having a three-fund portfolio will make it easier to diversify if you're choosing funds that reflect the market as a whole. Another major benefit to investing in a three-fund portfolio is having stocks at a much lower price. However, be warned that a three-fund portfolio is not as passive as if you were to just have an index fund. You will still need to pay attention to your overall allocation, and actively rebalance your stocks when necessary to stay aligned with your investment goals. There's also less room to move around when using this approach. Using a 3-fund approach to investing often means sticking with the domestic stock, international stock, and bond index fund formula. If you plan on investing in real estate or cryptocurrency, a 3-fund portfolio might not be the best thing for you. While this last method is not as passive as the funds we mentioned at the beginning of this video, if you implement all 3 key concepts together in your investment strategy, you're sure to see yourself with a healthy stock portfolio that has the potential to yield impressive returns over the long run. What do you think about our advice on how to become a lazy millionaire? Which piece of advice can you implement today? Let us know what you think in the comments section below. And if you enjoyed the video, please hit the like button. Don't forget to subscribe and hit the bell icon to be notified whenever we post new content. Thanks for watching, and we'll see you in the next one.